Ladies and gentlemen, thank you for standing by and welcome to the WDS 2010-2011 Annual Results Announcement Briefing. At this time, all participants are in a listen-only mode. There will be a presentation followed by a question and answer session, at which time, if you wish to ask a question, you will need to press star one on your telephone. I must advise you that this conference is being recorded today, Wednesday the 24th of August 2011. I would now like to hand the conference over to your speaker today, CEO and Managing Director, Mr. Terry Chapman. Thank you. Please go ahead.
Thank you. Good morning, all. Terry Chapman's my name, and with me this morning is Anne Hayes, our CFO, and together we're delighted to take you through our results presentation for the 2011 financial year. A net profit after tax was $5.4 million, which is up from our loss of last year of $7.5 million. With a revenue increase of 11.9%, up to $376.1 million. EBITDA, significant improvement, up to $32 million, an increase of 133%, and pleasing to see the operating cash flow generating $29.9 million of cash, up 88% on previous period. We've been very successful in reducing our net debt. It's now at the 30th of June was at $4.7 million, and we have a gearing ratio down to 2.7%, which we're particularly pleased with. Our work in hand has improved up to $279 million, up from $187 at the 30th of June, and we'll talk further in the presentation on some projects that will run post 30th of June. Earnings per share for the company, 3.84 cents per share, and we will be declaring a 1 cent dividend, bringing the total dividends for the year up to 2 cents per share, fully franked. Safety for our business is a core plank, not just for WDS but also for our clients, and I'm pleased to report that we've had a continual improvement on our path to zero harm. We've had a 23% improvement across our company in recordables. Last year we're at 8.4, we're down to 6.61. This has resulted in over 69% of all of our projects running for more than 1 year injury-free, which we're particularly pleased with. And in addition, our injury severity rate has been reducing. What we've introduced during the course of the year is our Track to Zero program, and this is a program that encompasses all of our systems and procedures and beliefs that underpin zero harm, not just to our people, but also to our clients. And this program will be the catalyst to drive the further reductions in our recordable injury rates, we believe. And increasingly, we're moving our business towards a leading indicator measurement culture. We're going to be recording, and in future years, we'll see data on leading indicator measures such as incident closeouts, inspection targets, and employee attitudes. I'll now hand over to Anne Hayes, who will take us through the financial side.
Good morning. Yes, going to slide 6, the table form of Terry's given you the highlights. Our operating revenue up 11.9% to $376.1 million, with an EBITDA up also 133.6% to $32 million. Our margin improvement on EBITDA, we've moved to 8.5% from 4.1% in the prior year, and Terry will go through the individual divisions, how they've contributed to these results. One of the things we've seen, we talked about last year in looking at the plant and equipment, predominantly in our E&I business, and we've seen some rationalisation of plant and equipment. Also, with lower CapEx spend over the last couple of years, that has resulted in our depreciation being $2.8 million, reduced from last year, and we expect in the current year that depreciation to be at a lower level again in the current year, but with CapEx spend this year, we're expecting sort of for next year we might see returns to higher depreciation levels. Our NPAT at $5.4 million, a turnaround from the $7.5 million loss that we saw last year, and resulting earnings per share for our shareholders of 3.84 cents. Slide 7 gives you a waterfall. Now, I've given the waterfall on profit before tax, and I've also adjusted, you'll see the bar at the left is our profit before tax last year. There were a couple of one-off items that I thought it was important to highlight those. and bringing it back to an FY10 profit before tax, excluding the one-offs of the impairment and the onerous lease costs. But the movement from that to this year's profit before tax of $8.5 million, we've seen revenue growth, and that's contributed an additional $3.7 million in margin. Then there's been margin improvement, predominantly through the E&I business, another $4.4 million. Decreased depreciation of $2.5 million. Now that differs from the 2.8 just by the impairment costs that we've taken up this year. Decreased overheads, $8.6 million. That's up from the $6 million we reported at the first half. And we have further foreign exchange costs unrealized of $1.2 million. That was about $800,000 in the first half. With our reduced debt, we've had an interest benefit to us of $800,000, resulting in a profit before tax of $8.5 million. So overall, revenue increase and margin improvement, reduced overheads, reduced depreciation, but offset by some increases in those foreign exchange losses unrealized on our Middle East operations. Our balance sheet, Terry's mentioned our gearing is down at 2.7%, down from 12.6% at June 2010. The balance sheet we have is capable now of organic growth. We've been strengthening that balance sheet in a number of areas. Cash has been a key focus for us throughout the year, as we've mentioned previously, and we've been able to reduce that debt level, allowing the facility that we have, which we did yesterday, in fact, extend our facility with GE for 5 years out to 2016. So that facility is, as we have previously, the $95 million. We have a $50 million working capital facility, which has a sublimit of $25 million for letters of credit and bank guarantees, and we have a $45 million asset-backed CapEx facility. So we're really pleased to continue our long association with GE and the renewal of that facility, and got better terms on the renewal, and it's for a 5-year period, so we're very pleased with that. Our capital expenditure for the year was $12.3 million, which is a little bit lower than we had in previous years, but we've said on numerous occasions the plant and equipment in the E&I business is underutilized, and we haven't had to spend an awful lot of money in E&I, and we've done some maintenance CapEx in mining. We've had $2 million revenue from the rationalisation of plant in E&I. Now the CapEx will increase through the next year, and we have also at this stage, we have actually approved over $16 million worth of CapEx spend that was approved in the FY11 year, but the cash outflow won't happen until FY12, and that's largely in mining and in our drilling business. And I'll hand back to Terry to talk through the operational overview.
Okay, if we move to slide 10, our mining business, again on the safety front, we've had a really significant improvement in safety attitude in our mining business, with a 43% improvement in our recordable injury frequency rate. We're at 12.3 in 2010, now down to 7, and we really believe this is right at the forefront of our industry. Particularly pleased about that. On the revenue side, again, we had a significant lift in revenue last year, you'll recall, up something like 26%, and we've been able to maintain that and lift it up a further 5.2%. So our effort in maintaining our work and increasing it has paid off. Our EBITDA, however, has reduced down to $20.7 million. We have had some margin pressures which were flagged during the course of the year, and these have been, as we previously indicated, due to some deliberate reductions in margins on lower risk contracts, some project startup issues, wage costs and changes in contract mix, and a second half impact which was on some of our regional workshops where we had some under recoveries of overheads due to reduced workload, which had a second half impact, and we have taken some significant steps in rectifying that, and they are trading profitably as we speak. As I mentioned, the revenue increase is due to some excellent contracts won in the course of the year. We were successful at Oakey and at Creek and at Tamor. body both at North Goonyella and Metropolitan projects down in the Illawarra, BHP Dendrobium, contract renewals at BMA at Broadmeadow, and the Yancoal Ostar projects. Moving on to energy infrastructure on page 11. Again, on the safety front, this business has now run 2 years with LTI free. Our total recordables went up slightly since this time last year, but it's improved since the half-year result. We're at 8.4 at the half-year. We're now down to 6.1. Revenue has lifted in the full year, which we're particularly pleased on, up 19.1%, and a significant turnaround in EBITDA, 15.5 million compared to the loss of 5.1 last year. Now, this margin improvement has occurred despite the significant impact we had in wet weather, which we've spoken about at length, and has come about due to improved project management. We've been very focused on reducing costs through the whole business, and particularly in E&I, and this has come through the bottom line. We've spoken about the plant rationalisation. We've still got utilisation significantly less than we would like. We're well positioned to take up the work as it comes, and we have been rationalising plant. And of course, our markets are still rather subdued, particularly in the infrastructure market, in respect that orders are still slow coming out, and I'll talk about that further on future slides. We're particularly pleased that we've now won our first of what I call the CSG LNG export projects. I mean, the majority of the work that we've done has been for domestic onshore type work, so we're starting to get work being awarded for the export phase of the CSG industry, and we have quite a robust tendering activity for longer term opportunities.